Welcome to vTalkInsight, Risk Sentiment Daily for February 18th, 2026. A sharp rotation into safe havens, pressure on big technology, and rising rate cut bets are colliding, leaving risk sentiment volatile and hard to read. Across major indices, the surface looks calmer than the underlying cross-currents suggest. Equity benchmarks spent much of the session in the red, with the Nasdaq down close to 1% and the S&P losing about 0.5% at the open, before clawing back toward flat by the close. At the same time, implied equity volatility pushed higher, with the VIX moving into the low 20s. That combination of intraday reversals and higher volatility points to a market that is nervous rather than relaxed about the outlook. Compared with earlier this week, when softer inflation data supported a more cautiously positive tone, today's backdrop feels more defensive. Defensive risk aversion and safe haven flows are prominent, especially into longer-dated government bonds and classic havens like gold and the Swiss franc. Yet market breadth has quietly improved, with the S&P 500 equal weight index nearing record highs and both cyclicals and defensives participating, suggesting rotation rather than broad liquidation. Credit markets still show risk appetite, with tight spreads and strong demand for new issuance, and IPO activity has rebounded sharply, with issuance and volumes up more than 70% year-to-date and new listings averaging solid first-day gains. Put together, the picture is one of volatile and defensive sentiment, not outright capitulation. Investors are cutting concentrated tech risk, adding hedges, and leaning into quality and international diversification, but they're staying engaged in risk assets rather than moving wholesale to cash. The clearest signal of defensive risk aversion and safe haven flows is in rates and currencies. Long-duration Treasuries have seen their strongest rally since April, with 10-year yields dropping below about 4.03% and shorter maturities falling back toward levels last seen in 2022. Flows into the long end reflect more than just policy hopes. They also point to rising concern about the growth outlook and even recession risk, especially as equity weakness coincides with bond yields at year-to-date lows. In Europe, German government bonds are again acting as the region's most reliable safe haven, and the Swiss franc has strengthened notably as investors seek shelter from geopolitical and macro uncertainty. Gold is expected to remain volatile but trend higher, underpinned by steady central bank buying from emerging markets, even as speculative flows add noise. Taken together, that is a classic flight to quality pattern across fixed income, currencies, and precious metals. On the equity side, sustained weakness across both technology and financials, alongside sharp drawdowns in select consumer names, underlines a cautious stance. Investors are rotating toward defensives such as utilities and staples, which have pushed to all-time highs, and consumer behavior is shifting toward cheaper private label products. Stress in parts of crypto, where a major platform is facing solvency questions and retrenching from Europe, reinforces the sense that more speculative corners of the market are under pressure. The key risk is that if growth data deteriorate further, these defensive flows could broaden into a deeper de-risking cycle. There are also reasons the safe haven bid might fade. Diplomatic progress between the U.S. and Iran on nuclear issues has already knocked Brent crude down more than 2.5%, hinting at some easing in energy risk premia. Meanwhile, leading indicators such as an ISM reading around 52 and record revenues at major U.S. banks argue that the global economy is not yet sliding into contraction. For now, though, the defensive risk aversion and safe haven flows remain a dominant force in cross-asset pricing. AI disruption and tech-led drawdown have become central to the current risk narrative. Investors are rotating out of long-held technology and software positions, particularly those linked to artificial intelligence, and reallocating towards sectors seen as more resilient. Defensive groups such as consumer staples and utilities have reached new highs, while big tech has underperformed and some marquee names, including a major e-commerce platform and large banks, have logged unusually long losing streaks. Heavy AI-related capital expenditure is a key pressure point. Record corporate capex, with hyperscalers planning around $650 billion and doubling spending year on year, is fueling debate over whether companies are overinvesting after decades of underinvestment. Recent announcements of roughly $120 billion in new AI infrastructure spending have been met with negative share price reactions, and a large streaming company has fallen about 25% amid concerns over AI-driven content competition. Industrial software names in Europe have also sold off as clients experiment with in-house AI tools, challenging long-standing digital twin providers and raising questions about business model defensibility. Market behavior around AI headlines has become binary. New product launches, even from smaller startups, have triggered sharp sell-offs in stocks seen as exposed to automation risk, while a pronounced divergence is emerging between baskets of perceived AI winners and those at risk of disruption. Yet the broader picture is more nuanced. Semiconductor stocks have outperformed software since last November, and despite large market cap losses in certain tech segments, major indices remain near record highs, pointing to rotation and dispersion rather than systemic contagion. For portfolios, this environment increases the importance of name selection and factor balance, as crowded AI trades and momentum strategies become more vulnerable to abrupt reversals. Sticky inflation and policy uncertainty are another important brake on risk appetite. Upcoming U.S. tariffs have not yet fully filtered into consumer prices, suggesting further upward pressure on inflation as companies pass through higher costs. Global labor shortages, including in China, are expected to push wage growth higher over the coming year, challenging expectations for a smooth, sustained disinflation path. With inflation still hovering near 3%, there is a growing view that current policy rates may not be as restrictive as central banks intended. Some argue that markets have gone too far in pricing aggressive Fed easing, noting that U.S. growth remains above trend and labor markets, while cooling at the margin, do not obviously require rapid cuts. Others highlight that the Fed could consider multiple rate reductions in 2026 if inflation returns convincingly toward 2%, but emphasize that current data do not yet justify that trajectory. AI adds another layer of complexity. Productivity gains linked to AI could be disinflationary by boosting output, but the heavy investment needed for AI infrastructure may temporarily raise costs for labor and commodities. That ambiguity is complicating the Federal Reserve's assessment of the terminal rate and the longer-term real interest rate. Upcoming inflation releases and FOMC minutes are therefore highly sensitive events, with the potential to shift both rate expectations and the valuation backdrop for risk assets if they surprise in either direction. Set against those headwinds, rising central bank easing expectations remain a key supportive force for risk assets. In the U.S., a sharp drop in two-year Treasury yields back toward 2022 levels indicates that markets are increasingly pricing a more aggressive Federal Reserve cutting cycle than previously assumed. The 10-year yield moving below roughly 4.03% and ongoing declines across the curve reflect growing conviction that as many as 3 cuts could occur this year, with some probability assigned to an earlier move. In the UK, soft wage data and rising unemployment have driven a rapid repricing of the Bank of England path. Market pricing now assigns around a 70 to 80% probability to a rate cut as soon as March, with at least 2 cuts fully priced by year-end and scope for a third if the data continue to soften. That anticipated pivot has weighed on sterling and supported gilt markets, while offering some relief to rate-sensitive parts of the UK economy. Lower expected policy rates reduce discount rates and can underpin valuations across equities and credit, helping explain why IPO activity has rebounded and why tight credit spreads persist despite volatility in equities. However, several managers caution that if yields move toward the lower end of perceived fair value ranges, they may view duration as less attractive, especially if growth proves more resilient than bond markets imply. The easing story is therefore supportive but conditional and vulnerable to upside surprises in inflation or data that challenge the current rate cut narrative. Beyond the near-term volatility, AI as structural growth and capital magnet remains a powerful bullish driver. Investment in AI infrastructure is robust, with strong demand for chips, memory, and data centers highlighted by recent updates from major cloud and e-commerce platforms. Large corporates are committing vast sums, from hyperscalers planning hundreds of billions in capex to groups like India's Adani announcing $100 billion of AI-ready data center investment by 2035, reinforcing a multi-year build-out theme. On the macro side, recent U.S. productivity growth has accelerated toward about 2.7% annualized over the past 10 quarters, and some projections suggest AI-driven efficiencies could push that even higher over time. Surveys show that AI adoption is in early stages, but is expected to enhance productivity rather than trigger immediate large-scale job losses, and household net worth remains near record highs with low jobless claims, which together support consumer confidence. Capital flows are aligning with this structural story. Thrive Capital has raised a $10 billion fund focused on AI, space, robotics, and life sciences, double its prior size, reflecting strong institutional appetite. Large tech companies' AI infrastructure plans are generating significant demand for private credit as borrowers seek flexible financing, while tokenization of traditional assets and clearer digital asset regulation promise to broaden institutional adoption of related technologies. Although concerns about overinvestment and regulatory or geopolitical friction, including around defense applications, may keep volatility elevated, the overarching narrative remains one of AI as a long-term growth engine that continues to attract substantial, diversified capital. To sum up, risk sentiment today is volatile and defensive. Safe haven flows into government bonds, gold, and the Swiss franc, together with AI-driven tech drawdowns and lingering inflation uncertainty, are keeping investors cautious even as indices hold near highs. Opposing those headwinds are rising expectations for Fed and Bank of England easing and a powerful AI investment cycle that continues to draw in capital and support productivity and earnings prospects. The balance between these forces will hinge on upcoming inflation data, central bank communication, and how quickly the tech sector can digest heavy capex and disruption risks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.